Hello again from Sprott Money at sprottmoney.com. We've reached the end of July already, so it's time for your monthly wrap up. I'm your host, Craig Hemke, and joining me is Michael Oliver of olivermsa.com. His work, Momentum Structural Analysis. If you watched the video I recorded last month with Eric himself, he mentioned what a big fan he is of Michael's work. And so I thought, well, geez, this is a layup. Let's get Michael in here in July and see what he thinks. So, Michael, thank you so much for spending some time with me.
Good to be back, Craig.
As we get started, two things. One, at the end of July and into August, we are still having the Sprott summer sale, the Sprott Money summer sale. If you go to sprottmoney.com, you'll see it right there on the homepage. Click it. It's one of the biggest sales of the year at Sprott Money. Great deals on physical gold and silver. And every day is a good day to be stacking, if you ask me. And Sprott Money will certainly help you out now through August the 6th. So you've got about a week or so to still take advantage of some great prices. Again, sprottmoney.com. Look for the summer sale. Michael, the other little bit of housekeeping we should do. I know who you are. Clearly, Eric knows who you are. But tell everybody a little bit about yourself and where they can find your work.
Well, it's olivermsa.com, our Momentum Structural Analysis. Been in existence since 1992. Initially, first 20 years, we only serviced institutional clients, major funds, hedge funds, some banks, etc. And we widened to open to the public, and we look at all four major asset categories. We don't just put blindfolds on and look at, let's say, stock market or bond market, but gold, silver, commodities, emphasis gold and silver, by the way. Stock markets, put an S on the end of that, not just U.S. Bond market and foreign exchange. And it's important because, especially now, I think more so than any time in my experience, which goes back to the mid-1970s, by the way. I got in the future side of the business entity of Hutton. The impact of one asset group to another is more important. It's more impactful now. And what we've seen, even since, well, for example, this year, you started out the year, gold rose from January through April, surged upward and paused in mid-April. And what did the stock market do during the first part of the year through mid-April? Collapsed. So, the total opposites there. And then it rallied off the April low. Gold paused. You would think, well, if gold's opposite S&P, S&P went down hard, it went up hard, then therefore gold should go down when S&P goes up, right? Well, it didn't do it. Instead, it went to sleep, comatose for 4 months. That is not the way gold market ever tops. When it tops, it tops. You go back to 2011, the 2015 low, 1980 high. I mean, it's an isolated peak and you collapse. Okay. When you go to sleep in gold for 4 months, while the stock market is sucking its money back in, instead of it flowing into the alternative of gold, but instead there was demand for gold anyway. There were sellers all for that 4 months, and yet it wouldn't break. You get these sharp little drops and then boop, right back up again.
Yeah.
Stock market, we think, is making a major top. We think it began in January. The fact that you made new highs recently, marginal, by the way, we're talking 3-4% above the highs of last year or early this year. That, as it tops, money flows elsewhere. It's never the case when money flows out of everything. You go back and look through history. Big stock bear markets. No, everything didn't go down. Certain things went up. The two things that went up most obviously were T-bonds, up in price, down in yields, long-term T-bonds I'm talking, and gold related. This is the stock. The gold has already been underway for 10 years upside. It has major cycles, and what they're really dependent on is not some headline here or there or some market here or there, but on the overall onward decay in the money unit, the dollar.
Right.
I don't mean the dollar versus the euro or the yen. I'm talking about the dollar's real buying power. So when I was a kid, a loaf of bread was 20 cents. Okay, it's not anymore. Okay. It's because of the decay in the dollar, not because of increase in bread prices. The real value of the dollar, you lose, it increases in quantity. M2, for example, almost doubles every decade. Huge, almost doubles every decade. The population doesn't double every decade. But anyway, and now recently, the last 10, 15 years, it's gone up even more steeply. You look at an M2 chart from Federal Reserve and you'll see it. Well,
Right.
so naturally, prices of things go up because the value of the dollar goes down in real buying terms. It takes more dollars. So people that cheer, for example, the stock markets, it's stock market, got to be there. It's always making money. Let's go back 25 years, throw a dart. July of 25 years ago, the July 2000, S&P's more than tripled since then at current price levels. More than tripled. Sounds good, huh? Gold's gone up 11-fold. Okay, 11-fold.
Right.
Okay.
Right.
Now, yeah, if you flint return, no, you didn't get the 11-fold gain, but it's gone up 11-fold with definable bear markets in between that we've defined. And right now we turned bullish on gold in 2015. February 2016. 2.5 months off the bear low, which was 1,050. Right now we're 3,400 area. Nothing since then in that 10-year period has altered our annual momentum trend analysis of gold. And that's what do we mean by that? It's when you measure gold monthly action, monthly bars, like a price chart, but we measure them versus a 3-year average or 36-month average. And we plot them as an oscillator, meaning, okay, this month's high, low, and close are how much above or how much below that changing average. And it ends up, you have an oscillator. It goes above the zero line, it goes below it in bear market, et cetera, et cetera. Nothing structurally in terms of defining the trend on momentum is even threatened right now in terms of breakage, downside breakage.
Mm-hmm. Okay.
We see all the evidence here that this pause in gold, 4 months now, total boredom, is about to launch again, and it probably will launch next month, my best guess. Now, look what's uniquely happened, though, in the last 4 months. While gold has gone sideways and yawning, not going down, but just sideways.
Yep.
Silver's gone up explosively. We've gone from the upper 20s to the upper 30s in that 4-month period. And if you look at GDX, for example, it's risen sharply as well, while gold stood still. So it used to be the other way around for the last several years. Since that 2020 upshot we had in gold, the miners and silver, they peaked basically in mid 2020. Gold had a range-bound situation, 20% to high-low, but silver and the miners tended to retreat more.
Right. Right.
We're arduous. They get nice rallies, but it'd be a zigzag to the downside while gold went sideways. That is shifting. It's shifted in the last several months, especially since April, where the miners, if you plot them as a spread, meaning divide the price of GDX into gold ounce, express it as a percentage, and plot that chart.
Yeah.
And you'll see that it's broken out over trend structures that are easily defined when you plot that spread. Downtrends, horizontal lines, etc. So, and the same with silver. So what it argues to us is that, okay, now we're about to enter, we've entered the phase where those parts of the monetary metals complex will lead gold. This has happened before. And usually when it happens, it's quite dramatic. In fact, if you go back and look at that bull market in 2001 to 2011, in 2010, silver went vertical while gold continued up, but silver exploded geometrically.
Right.
And we're at that phase now. In fact, if you even just look at a price chart of silver, any of your watchers, just go look on your quote screen and get a silver futures continuation chart, meaning it rotates to the next active contract. Okay. Go back to the 2022 low. Remember that low? That's when we paused from 2020, 2021, and it was flush in gold. It took it from like $2,000 down to $1,620. Well, silver also went down then, made a low. Miners, same story. If you plot the action since 2022 low, which would have been like August, September of that year. You could plot a parallel uptrend channel on price even. You've emerged through the top of that. Yeah, an upward bull market, but at a definable angle of recurring rallies and lows that just stay in the tube, and frustrate people because you get these sell-offs in the tube, but it's still rising. They forget to see that. We've blown through the top of that. We did that about a month ago, and after doing it, we've paused. But we're above the channel top and comfortably quiet. So we've had a breakout, even evident on price, much less momentum, which already broke out before that. So I think we're headed to, pardon me, my camera is moving.
All right.
I think silver's has entered now that acceleration phase. Our expectation is this. It's not outlandish. The $50 highs we saw in 1980 and 2011 in silver. Think about how much time has passed. Well, the decay in the money, even since 2011, has been enormous. Yeah. So even just to get back to 50 isn't getting back to 50 in real dollar terms. We probably have to go to $200 silver just to match the 1980 peak, at $50. Okay,
right.
I think we're going to go to $60 to $70. There was below the $50 highs out, what I call idiot highs, because they really don't mean too much, especially in real terms. And do that this year in this surge that we've now commenced.
This year?
This year, meaning in the next 5 months or so. There might be a pause there. I'm not sure. But I think at least we're going to blow out to 50 and not even pause till we're credibly beyond it. Now, is that the end? No. We're in a different situation now. I think you know it. Eric Sprott knows it. A lot of people know it. This isn't just another gold, silver bull market. This isn't just 1980 and then it's over and you go down to hell for the next couple of years, or 2011 and you go down to 2015. There are things going on out there that are far more disastrous, pending, and already commenced, that will impact monetary metals. We don't call them precious metals. Platinum's a precious metal. Gold is a monetary metal. So is silver. And that is that when that shit hits the fan, pardon me, you have to edit that out. The central banks will go more berserk than they have ever been. Because not only will stock market go down, but all the data points they like to chatter about, how, job market's looking good, which it really isn't when you look at the inside data. But once the market starts down, if you go back and look at the 2000 top to the 2002 low, 2007 top, 2009, all the data points that they like to chatter about really started to go south in an obvious way once the stock market topped.
Yeah.
And started down. And finally, people started pulling their hair, and there were the CEO says to don't hire any more employees this month. We're on pause or lay them off. And all of a sudden, the data points will shift. That's when the central banks will go ape. And they always do. They always do. If you go back and look at those two tops, you'll see they started cutting rates like crazy. It didn't help the stock market. What helped? Two markets went up during that time, gold and T-bonds. Question now is T-bonds. You mentioned that.
Yeah, please.
Yeah. Well, the T-bonds they're not responding to the Fed. They usually don't, because that's the long end of the debt market. We're talking 30-year T-bond futures, okay, not the 90-day stuff. When the Fed cuts rates like they did, back late last year, a couple times, took it off the high, the recent high, shallow high, by the way, in terms of rates historically. T-bonds went down in price, up in yield, despite them cutting rates. And if you look at a T-bond futures chart or a yield chart, which is the opposite, of course, they're clustered. T-bond prices are just laying on the floor, anemic looking, despite even during that drop in April in the stock market. Didn't help the bond market. They tried to go up in price. There was a nice rally into early April, but then they collapsed. And they're just laying here a point or two off the floor of the last, actually, several years. So the long-term rates are choking, and they're not letting loose. The noose is not getting looser. It's just as tight as it was 2 years ago, which means there's a lot of big corporations, especially commercial real estate, and plus the government is hurting because of this. So we don't just have a mortgage problem like we did in 2007 to 9. Now suddenly it's government debt, not
Right.
family
Right.
mortgage. We all know that there's credit card excesses, by the consumer. They're at their limits. They're past due. We also know there's a lot of late filing of taxes now, increased sharply. People just can't pay it, so they delay or they try to set up a plan. Something's hurting already. But when it becomes bleeding obvious to the central banks, gold already knows this is going to happen.
Mm-hmm.
That's why it's not sitting and waiting for the bad data points for the Fed to cut. It's already on its way. It knows. And not just the US, but the Japanese have been doing it, and we know the EU will too. So that's the dynamite. So we watch the stock market because it's going to have an impact on the central banks, but also money flow. If people get out of the stock market, they go somewhere. And they usually go to those two things. But if you're a portfolio manager and you're looking at gold and T-bonds ain't working. Only gold's been working. Gold's up, despite the pause, is up a lot more than the stock market this year, the last 3 years, the last 10 years even. You go back to 2015, gold's beating, anyway.
I'm smiling as you talk about, what's NVIDIA's market cap now? Like $4 trillion. 1% of that comes out of just NVIDIA, and that's $40 billion. The whole GDX is only worth about 15. So
no, it's a wet bar of soap, it's a tiny little sector of the stock.
Yeah.
And when the people start to grab it, I think they've already started.
Yeah, good way to put it.
Sprott Money has already said, hey, I've seen enough evidence that something's wrong with the stock market. Yeah, it made a new high here, but it also did. See, we called the stock market top in 2000, in January of 2000. It had a drop into February, but then it came up in March of 2000, made a new high.
Hey!
Our subscribers said, oh, golly, you're wrong.
Yeah.
It didn't go anywhere. It made a new high.
Yeah.
It plateaued for the whole year. It just wouldn't go down. But it also really didn't go up. It just held. It was topping. It wasn't until 2001 that it really started down. That's when the Fed started cutting rates, by the way.
Mm-hmm. Mm-hmm.
And in 2007, you had another arduous top where you made a peak in like May, June, July of 2007, had a sharp drop into August, just like we had into April, came back up and made a new high.
Yeah.
Fed cut rates then, by the way, to help create a new high. That was the top, but it was arduous.
Yeah.
So it really fooled people just looking at a price chart. When you look at momentum, you see the stock market totally differently than when you look at a price chart. And that's why we argue it's a top.
Michael, again, what you do is proprietary, really. It's your system with momentum as that big part of your analysis. Let me ask you kind of a fundamental question, though, that has been one of the big questions here in this month of July. And that's this notion, Trump has made it clear he's not renominating Powell, right?
Yeah.
And he's beating him over the head almost every day, telling him to cut rates. Powell's obviously not just going to quit early and retire. Even if Trump were to find justification to fire him, one way or the other, we're getting a new head of the Fed by May. And it's pretty clear that Trump's going to nominate somebody that's going to cut rates immediately. You would think with that policy, perhaps comes some kind of yield curve control too. From a fundamental standpoint too. Do you can you see that as a basis for?
I think it's just part of the fact these things come and go. What you're talking about, where the Fed changes dramatically. Okay.
Yeah.
This one is the political realm to it. We know that it hasn't been true in the past so much as now. And I just remind everybody who regards Trump as a free market advocate. You're not a free market advocate if you advocate the central bank, in other words, the monopoly control over the commodity of money, artificially prices money well below reality. Like he wants to go to 1%. Why not free? What the heck? Let's go back to free again. That's helped the stock market for 15 years go up. It's a bubble. You print money, money's free. It goes up. Okay. So when you look at it that way, gold knows this is coming. It doesn't matter who's the president, who's the head of the Fed. Even Powell's going to shift. And I suspect he'll shift probably in the next month or two. Because once you get a few bad data points, and I think that unemployment data, for example, is so creepy how they interpret it. is, last month, for example, we had a gain of whatever, 150,000 jobs or whatever it was. Half of that was government jobs, state and local government. Okay. And then the other parts of the gain were hospitality. God, we need bartenders. I know that, and waitresses. And home care workers. Somebody's got to take care of grandma. Okay. But when you take that out, the major parts of the economy were flat to negative growth in jobs. Okay. Offset by state and local government, which is the core of the economy. We know that. Okay. All right. So, but Powell takes the overall numbers as the job market looks good. Well, he's got 2 Fed governors already who've said, we want to cut now. Okay. All you need is about one more, and suddenly it gets to become a chorus. And even though there's a lot more governors than 3 in Powell, but still, you start to get more. Another one here, another one there. Powell's going to get tapped on the shoulder by these people inside the Fed. And he's going to pretty soon have to say, these guys see reason, and, this is a committee, and he'll cut rates. I don't think he's going to wait till May and be some kind of political hero. So, all it's going to take is, if the stock market, for example, is topping as we think it is.
Right.
If all of a sudden we find the stock market, you're back below the prior highs. 2024 for the NASDAQ, 2025 for the S&P, the highs that occurred then. If you slip back below that, then suddenly that breakout doesn't look like a breakout. It looks like a teaser. In fact, there's one of the first books I ever bought in 75. I was working for Hutton. I didn't know anything about technical analysis. And of course, everybody then was a technical price chart technical. Edwards and McGee wrote a book in 1958 called Technical Analysis of Stock Market Trends. It's a big, thick, 400-page fine print book. Weighs about a pound. Okay. And I bought a hardcover copy. There was a financial bookstore somewhere near Wall Street. I remember, walked by the front, and there was that book in the middle of I bought it. I still have it. They have a price chart pattern that very few people talk about. It's called the broadening top. And it is exactly what I was talking about, where when you make a top, sometimes it's confusing and it makes a new high, even after it's really started the topping process. Well, what they have is, we know what a coil is when it gets narrower, price narrows over time. Yeah. This is the opposite. It widens. In other words, you got a 5, 4, 3, 2, 1, 3 highs, 2 lows, and each is higher than the other or lower than the other. So it's a widening pattern when you look at price. Well, right now we're at point number 5 in that 5, 4, 3, 2, 1 broadening pattern. And I've not heard any orthodox price technician on CNBC or Fox Business talk about the chapter in the book, the orthodox chapter of technical, that defines a broadening top. I've never heard anybody say that. And yet it's a classic pattern. And it's developing not just in the S&P and NASDAQ, but I can find it in a lot of sectors, including some stocks. NVIDIA, to some extent, has that pattern. You roll over now and just get back below the early year highs, and that's going to start people wondering, hey, is that real?
Yeah.
Is that a trap? And that's when the concern it won't take much. We're talking about 3% drop below there.
Right.
And suddenly, oops. Well, I thought that was a breakout, man. Okay, you get the point.
Yeah.
And at that point, you better never, ever take out that price low we saw in April. Because when that drop started, we got bearish in January, and it took it like a month or two to finally get going. But before we got to that low, we said, okay, watch out. There's going to be a bounce point in this sell-off, and it's going to be 4,800 area for the S&P. Well, its low was 4,835. And for the NASDAQ 100, it's going to be in the 16,500 area. It stopped almost precisely there and bounced. The bounce was bigger than we thought because it made a new high. But I don't trust the high. So that's a factor to watch if you're in the gold market. Because it'll stimulate the Fed into what they do best.
Yep.
It will cause money to flow elsewhere. I think it's already beginning. Gold miners. If you're fleeing the stock market and you don't invest in silver futures, let's say, or you don't go out and buy bullion, okay? Right. What do? You buy miners.
Yeah.
And I think that like the Newmont report, they just realized, hey, these guys are making money, man.
Yep.
Newmont, which we had expected, by the way. Money's flowing into those miners. And I think it's a recognition that don't trust the stock market. And hey, we really missed something here. These guys are doing very, very well, and they're not priced sufficiently.
Yeah, almost a value play.
Yeah. I think it really is. And our expectation is over the next, to give you a relative gain, miners could triple in relative value to gold over the next year or two. Triple.
That would be substantial.
Now, gold's at 3,500. Let's say it goes to, I don't want to be silly about this, but it's twice before you've had 8-fold bull markets. 1980 peak was an 8-fold gain from its bear low. 2011 peak was an 8-fold gain from its prior low in 2001. If we have an 8-fold, it means $8,000 gold.
Yeah.
Whoa. Can you imagine where GDX might be if it tripled in value? Okay, you get the point. And silver could go even more berserk in terms of regaining value.
Michael, in our final minutes, I do want to ask you though about the mining sector, because we've covered most everything. But on that, and again, and this is a little more, I guess, technical in nature question. I've watched every day the GDX pounding up against 54, 55 and just unable to get through there. And I look back and I see this huge head and shoulder top from 11 and 12 with the shoulders at 55 and the heads up here at 65. So to me, there's a reason why I can't get through 55.
Actually, we calculated lower than that, but I'm sorry. There was
okay.
There was a low monthly close in GDX coming off that 2011 peak that was lower than where we are now. So we're actually above it. If you look at that low close and plot only through closes, monthly closes, you'll see it's slightly lower, meaning we're actually above it. The one that's poised right at it right now is SIL. Silver's the gold is the
silver miner one.
The silver miner ETF. It's around $50. You look at 50 on it. It peaked over the last 9 years or so since 2015, like the 2016 rally, the 2020 rally. It keeps peaking at 50. This is the third time. You close a month out, and we're trading just below there now. We've been above it intra-month. You close a month out credibly over 50, and you're going to blow through even a price chart base.
Okay.
Momentum's already blown that stuff out, but price is usually lagged, and it's got the base that any idiot could draw with a line for the last 10 years and say, we just broke out a huge base. And I would argue when that happens, you're going to take out the 2011 price highs on GDX and SIL fairly quickly.
Well, that's something to watch then here. I mean, we're recording this on the 29th, so we'd want to watch here at the end of July, $50.
August, any month that closes credibly over 50. Maybe the month it does will be 55. I don't know. But it has a price base. And even, most people look at price charts. They don't look at our momentum charts. Our momentum charts say it's green light, be bullish. But when you cross that price threshold, even the price guys are going to say, Golly, I missed this. I got to be in this. And that's when the money flow, like you said, you define the numbers, it'd be massive. It's a wet bar of soap.
Right. So, all right. So for people that want to follow along, olivermsa.com, correct?
Correct.
And you can, if I remember right, Mike, you can kind of pick, you can get the full buffet if you want, or you can kind of pick, do you want the precious metals analysis? Right?
Do just gold, silver mining report or the broad category. So, but if you ask for sample copies, we'll send them out. You can peruse through them. Okay.
Perfect. And, I like to say, again, Eric Sprott values your work. And this is my chance to kind of tuck in my favorite joke. Michael, you got you started E.F. Hutton. So now we can say when Michael Oliver speaks, people listen.
Oh, you remember those ads?
Yes, for sure.
In a restaurant, and somebody leans over to his friend and says, E.F. Hutton said, and everybody shuts up.
They lean in there real close, and they do one of these deals.
They ultimately went under, but anyway, it was fun being there.
Well, that's what it is now. When Michael Oliver speaks, people listen. So please check out olivermsa.com. Michael, thank you so much for your time. It's been just fantastic and very insightful. Really appreciate it. And from all of us at Sprott Money, sprottmoney.com. Again, go to the website, check out the summer sale, get yourself some physical gold and silver. If you just listen to what Michael said, these prices are still pretty affordable. Everybody, please subscribe to this channel too, because there's going to be a lot more content coming at you in August. You don't want to miss any of it. For now, though, we'll wrap up the July monthly wrap up, and we'll see you again next month. Thanks for watching, everyone.